All right, so the Dow is only up 11 points, but we are seeing the S&P and the Nasdaq up another 0.25%. Has the bull market resumed?
I definitely think your risk reward has improved a lot. I mean, if we just go back to where we were, a few months ago, equity volatility was too low. Bond yields were probably too low. Equity valuations, biggest premium you'd seen since the tech bubble. That's all changed. Volatility has sort of normalized. Bond yields, we think we're at sort of peakish levels right now. Valuations have come down a lot. And throughout this period, earnings expectations have just continued to rise. So we're moderately constructive on equities here. More upside in places like EM than in places like Europe. But yes, there's definitely room for markets to move higher here.
There's a lot to unpack there. You say you're modestly constructive. Why only modestly? I mean, if multiples have come down because earnings have been so good, that would bode well, right? Especially if earnings continue to show signs of strength.
So I think valuations are still the risk. I mean, they've come down a lot, but you're still at premiums at a time when policy is tightening in the US and multiples traditionally come down about nearly 10 percentage points a year when that happens. The surprise was that didn't happen last year. It's beginning to happen this year. That remains the risk. The best insurance policy for that is to buy as much earnings growth as you possibly can. And that's what our sort of overweight of the US and EM have in common. Lots of earnings growth relative to the places we like less, such as Europe and Japan, where there's really no growth.
Yeah, I want to focus in on that lack of growth overall, Ben, because I'm looking at a chart at the moment that really is just showing how much earnings per share really has recalibrated itself in the US. In the yellow line, we're seeing earnings per share estimates have really gone up to the tune of 8% since the beginning of the year. Analysts recalibrating, thinking that we can see a push higher in the US. But look at what laggard in the white line. We're seeing European forecasts for growth really dwindling behind the US. Is it really going to be that stark? Are US companies outperforming on an earnings per share basis that much more than Europe?
Yes, so you just saw 4% earnings growth out of Europe in the first quarter, so real numbers. You saw 26% in the US, so that's the gap. In the US, people like to say it's just tax reform. I think there's a lot more going on than just that. Margins are still expanding. It's the only place in the world you're seeing a real capex recovery. And in Europe, I think it's a bit of a trap. You've got the most depressed earnings in the world, so people want to believe there's going to be a big recovery, but it's really not coming. And this is where you're seeing this GDP slowdown, which is sort of leading the world. Bund yields are going higher. Policy uncertainty, you were talking about Italy just a minute ago, it's still pretty high. That's stopping capex from recovering. And this is the part of the world where valuations are still very high, and it's the biggest overweight investors have. So I really struggle to see how you make money in Europe from here.